Hello and welcome to Weekend Investing Daily Bytes. Today is Valentine's Day. I was wearing red to usher in the Valentine's Day, but the market painted the entire all segments bloody red today. A bad day from a market's perspective, but let's get on with the business of having our daily bite where we are studying historical trends and Nifty's affair with 200-day moving average in the past. That will give us some learnings in terms of how Nifty behaves above or below its 200-day moving average. But let's take a look at the gory market for the day. So as you can see, all sectors were demolished. PSU banks, real estate, metals, private banks, automotives, commodities, infra, everything was pretty much bashed down. IT and pharma were the sort of two sectors which were relatively lesser damaged at minus 1.5% and 1.9%. But pretty much the sell-off was extremely strong and continuous through the day. There was hardly any relief rally during the day. So markets are continuously following the global news about Russia and Ukraine, and the Dow futures falling through on Friday evening and then again during the market today. So it seems that we will take cues from overseas more, and of course I do expect the FII numbers etc. also to be heavily in the red today. So the last today combined with the rest of the last week has now resulted in a reasonably big cut on banking and real estate, and has kind of disturbed this entire picture of the up move that started from the budget. And while it had given up a few days earlier, one was hoping that the new leg will start up again, but that seems to have been dashed for now. In terms of the broader indices, Nifty has closed 3% lower. Nifty small cap indices like small cap 250 has closed 4.25% lower. Mid and small cap is 4% lower. Nifty next 50 is 3.5% lower. CNX 500 broader index is down 3.3%. So everything is down in the range of 3 to 4.5%. The small cases, most of them have fallen even further, between 5.5% to minus 1.8%, but mostly in the range of 4 to 5% is the damage for the day. So pretty gory day. This Valentine's Day will get remembered for some time. But let's look at the Nifty's affair with the 200-day moving average, and for this I will take you to the Nifty chart and see how the Nifty has moved along the 200 DMA, and how other indices have also done. We can also take a look at some other global charts and see how they have done, and then we'll come back and see the number of sessions we've spent below 200 DMA on average every year or every time we go below it. So this is the Nifty chart. Let me expand it to last decade or so. So that blue line is the 200 days moving average. And while there is no magic in this 200-day moving average, it cannot say for sure that if the index is below 200-day moving average, it's a good buy. Nothing like that. Because if I go back further, I can show you the great financial crisis. And here you can see that when 2008, when it breached the 200 DMA at around 4800, it still halved from there in the next 6 to 8 months. So, the 200-day MA is not like sacrosanct of that if you reach 200-day MA, you should buy blindly. But it does give you a very high probability of at least the excesses having been taken off by now. So every time you see in the last decade, it has come below the 200-day moving average, whether it was in 2011, whether it was in 2015, and some portions in 18 and 19, and then of course the pandemic crash. So every time it is below 200-day moving average, I would say some parts of the market would become attractive from a from a value perspective at least. And of course, momentum stocks, momentum strategies will start to give up on their positions and go to cash or go to defensive sectors, etc. So this is where we stand in terms of Nifty. And if I zoom this further, today's close is just about at the 200-day moving average for the Nifty. And the last time we came to the 200-day moving average was we took support in September 2020 after having crashed below, then gone up, and then taking support. And now we are here again. So whether we will take support here and go up, or we will crash through, is something that we will need to see. And this last, if you see the Nifty range, so from August onwards roughly, Nifty hasn't moved anywhere in that sense of it has been sort of bound by this range here that we have. So we may keep bobbing around here. That is also one possibility, because after a rally like this, a long period of consolidation is expected. If you see in the history, anytime we had some very strong rallies, let's say this rally, we got this consolidation here, then after that, then we had this rally from going from 16 to about 18 top, then we had this consolidation here, and of course we also dropped because of the pandemic. Prior to that, let's say if we go back further, again you can see that we saw a dramatic rally after the 2008 crash, and this rally, and then market went into consolidation here. So consolidation is a part of life in the market. We have gotten very used to new all-time highs getting hit on the market all the time in the last 2 years, ever since we made this bottom here. So some period of consolidation spent in sideways or slightly downward mode is not so bad for the long term, but of course it is painful, there is no doubt about it. Let's also look at some other markets to give a reference of where we are in terms of the global markets. So in terms of the US market, again it is a similar situation where the Dow or even the S&P 500 have just crossed below the 200 DMA, and they made several attempts before that, but it is also kind of consolidating here, and we have been doing much better than a lot of other sort of emerging markets or Asian markets. And in Hong Kong, for instance, you can see the 200 DMA was broken way back in July 21, and they haven't actually moved up since last 3-4 years. So several such markets are there where there have been no major gains. We have been fortunate that we've had 2 years of good gains before this patch of consolidation has come in. Now, for people who are investing for the long term, who are gradually bringing in money, these are opportunities of sipping during consolidation. Of course, one would want their portfolio to go up and see green on your portfolio value, but given that this is cyclical in nature and one will have to go through these cycles, this is a part and parcel of the the market game, so as to say. So let's go back to the presentation, and we'll also see now where we have been in terms of Nifty below the 200 DMA, what kind of time frame we have spent in the past on this. So we've listed the last 2 decades, 22 years of all time periods where Nifty has been below 200 DMA. And there have been several, there are 8 pages worth of this data. So if I were to sort of, let me see if I can sort this. No, I can't sort it. So essentially you can see that during the dot-com bust, we spent almost a year around 2000, 2001 in drawdown with below the 200 DMA. Then in 2002 again we went about 141 days below. I'm not sure why my cursor is not working. Okay, so maybe I'll just summarize this here. So the total trading days of 5,500 in the last 22 odd years. We have been below the 200 DMA about 1500 or 87 odd days. So which is about, I would say, 23%, somewhere near that of the time was what we spend below 200 DMA. And as I said in the introduction, there is no sacrosanct view about 200-day BM being a must buy or a must sell situation. But in general, we have seen that whenever markets are below the 200 DMA or at the 200 DMA, those are non-frothy areas to maybe start investing or to add more, so on and so forth. So we have not been below 200 DMA since July 2020, and we've been above it for 578 days. So in case we do go down, I think those will be opportunities for longer term players. Of course, for shorter term trades, one may want to get out and sit out if one is long only short term trader. But for long term strategies, these are good areas to add capital and to bolster your portfolio. One need not be scared about the market going down, because that never helps. Of course, it hurts when the market goes down and our portfolio bleeds. But in order to make those gains, whenever we do get positive years, we need to bear this period. So with that, I'll come to a close on this daily bite, and I'll see you in another video. Thanks. Bye.